Good morning and welcome to MarketCast 26 live here from Bournemouth, and I should kick off by apologising for the fact that we're not live in London, which was our initial plan. So huge apologies for those of you that had asked to come and attend. We were going to do a MarketCast in front of a live audience, which we thought would be a huge amount of fun. Logistics problems unfortunately got in the way, which means we've had to postpone that till the spring, but we will do it. And let me say this, that those of you that actually emailed in and asked for a seat at that live MarketCast, you will be given first option when we get together in spring. So in the meantime, you find me in fine spirits. I'm in a ebullient form this morning, and apologies straight away as well for the shirt. Now, the reason I've got the Christmas shirt on, of course, is because this is our last MarketCast of 2024. We'll let you off in December, and so I felt I ought to get into the festive spirit. I hope you like it. I'll be having a word about my shirts at the end of the MarketCast this morning, but we've got lots to get through. I thought what would be fun, I'm going to give you my full prediction for 2025, some really important things that we need to talk about in Q1 and Q2 of next year with the stamp duty changes that are going to have a dramatic effect on the market. We'll come to those in more detail shortly, but I thought it would be good fun to take a 90-second, it says 3 minutes on here, I'll try and go quicker than that, a really swift trip through what 2024 meant and why we are where we are with the property market as it stands. So let's have a little look at 2024. I'm going to need to do that because my remote now has just decided it's not going. I've gone forward too. We'll see if we can make it work from there. So January, this is a quick trip through 2024. So in January, we kicked off with all of the big banks and institutions saying sub 4% mortgages were going to be the order of the day. The Co-op came out and hit the headlines, but hard on their heels were Santander, HSBC, Nationwide and all the rest, following the big institutions down under 4%. It was a great start to the year. In February, we had this extraordinary situation where the government actually finally announced the revised figures for the economy for the last quarter of 2023 and said, guess what? It was negative growth. So actually, we are formally in recession because we've had 2 quarters of negative growth. And in the meantime, Rightmove reported the first hike and increase in asking prices for about 9 months. So it's extraordinary. So we had this dreadful situation in recession, and yet the outlook seemed to be positive. There you go. Crisis? What crisis? And March, of course, brought the budget. This was Jeremy Hunt's do-nothing budget. So this followed hard on the heels, don't forget, of course, of the disaster with Liz Truss and Kwasi Kwarteng, and this was all about calming the markets down. This was his mini budget, and I love the whole thing that the big shock was that he actually said nothing at all. Rachel Reeves possibly could have taken a leaf out of his book, but still we'll come to that later. In the meantime, have a little look along the bottom of the screen here, because down there is the average nationwide, the price according to the Nationwide of average price of a property in the UK. And you'll see then how the market's moving as we go through the year. And then in April, well, inflation finally falls below 3%, so we saw it climb from February 2022 when Russia invaded Ukraine and energy prices went through the roof, and we saw inflation climb accordingly, and it's been falling ever since, and it finally fell below 3% in April. This was good news and gave us all hope for interest rates. And then the day after I said on MarketCast that the general election will happen in November, almost certainly, I'll lay my reputation on it, Rishi waited until I went live with that comment and came out the following day and said we'll have a general election in July. Well, thanks for that, Rishi, and I hope you've learnt your lesson given the result. And then, of course, in June, we have this dreadful pause. It was a vacuum, wasn't it? The big pause gag was noticed by some, but not by all. I've just got to tell you that. So we had this triple whammy with the market going on hold and holding its breath. Number one, we had interest rates which were on their way down, and everybody had this FOMO issue. Why would I want to sign up for a fixed mortgage now for the next 2 years when interest rates are probably going to be 1 or 2% lower in 6 months' time? So they were hanging on. The election Everybody hangs on before an election. It's happened over the last 5 elections. We see how activity goes on hold, waiting to see what the new political picture is going to be. And of course, it was summer as well. So you had the triple whammy then in June rather. And then landslide victory in July. Starmer's Labour Party absolutely sweeps the board. It's a completely new political landscape. And we get a new housing minister. This is Matthew Pennycook. And let me just share with you a little fact, because this will make you chuckle. So this guy here was actually first appointed on the Labour benches as shadow housing minister in 2021. Now, here's the thing. In between him becoming shadow housing minister in 2021 and him actually becoming the minister, the housing minister, in July, we had no fewer than 6 Tory housing ministers. There you go. There's Chris Pincher up there, Stuart Andrew, Marcus Jones, Lee Rowley, first time round, Lucy Fraser, Rachel McLean, I met her at HMIC, and here we go, Lee Rowley, second time round. 6 Conservative housing ministers, and all the time Matthew Pennycook was just waiting for his moment. So at least now, hopefully, under this new government, we'll have some consistency in housing policy. Let's see what a difference that makes, or possibly none at all. And then, of course, in August, we had the first rate cut from when rates started rising, December 2021, and we saw the rates start to rise. We finally got the cut, 25 basis points in August, bringing the rate down to 5%. And the prospect at that point was looking good. And then the Labour Party started preparing the ground for the next budget and for the conference season by telling everybody everything was dreadful. They painted a picture of how much worse it was than they thought when they were in opposition. Now they're in government, this huge black hole. It used to be just a little bit of 25 billion, which is pretty much just spare change, isn't it? And suddenly it's ballooned to 40 billion. And they were bringing everybody's mood down. And then in September, consumer confidence plummeted. And clearly they all got together around a table somewhere just before the party conference season started and said, yeah, perhaps we've overcooked this a little bit. And then in October, we had the budget, of course. And wonderfully, Rachel Reeves told the UK public before the election, no income tax rise, no VAT rise, no national insurance rise, which she didn't quite finish that sentence, did she? Because what she actually meant was no national insurance rise for employees, but for employers, we are going to whack them with a good old £40 billion tax bill. That was in October. And of course, the changes, and you can see what's happening, by the way, to the average price of a home in the UK while all this is going on. And this has now started to even out here. And of course, the changes in inheritance tax for farmers meant that we saw them all come to London with their tractors. Some of them very attractive tractors too. I used to like tractors, but now I'm an ex-tractor fan. All right, sorry. And we also, all right, everybody, it's Christmas. This is the Christmas edition. You're allowed to do it. And we also saw inflation unexpectedly popped back up over 2%, but we'll talk about that in a bit more detail in a moment. And that brings us bang up to date. So that was 2024, a microcosm for you, a 3-minute microcosm of what happened in 2024. So where are we now? A quick look at the key issue that came up in the budget, and it's this one. I've put it here in red for you, that as at the 31st of March, the tax breaks that Jeremy Hunt gave us on stamp duty, which are due to run out, will run out. We hoped that they would be extended. They're not. And that is going to affect things dramatically for the industry in Q1 and Q2. More of that in a moment or two. But essentially £40 billion worth of tax rises in that budget, most of it borne by employers, with employers' national insurance contributions going up from 13.8 to 15%. And of course, the threshold at which NI for employers NI gets charged being dropped as well. Investors got hit hard with a further 2% charge on stamp duty land tax, so from 3% to 5% for investor and buy-to-letters. No extended relief for the FDBs, and the consumer confidence barometer, which crashed So everybody took a deep breath and it stabilized slightly. Inflation jumps to 2.3, which kills the chances of another rate cut probably before the end of the year. Volumes continue to climb. And in September, mortgage approvals, completions hit a 2-year high. So good news there. Let's quick look at the key dates that are coming up. First of all, inflation numbers. The next inflation numbers are due to be published on December the 18th. So, and of course, as night follows day, literally the following day, on Thursday, December the 19th, the MPC meet. Most unlikely that we're going to see another rate cut. I gotta say, I did MarketCast last month and I was actually quite upbeat about the prospects of a cut both in November and December. Well, of course, November we saw the cut 25 basis points down to 4.75, so at least we're under 5% now. But December, the prospects now look very unlikely indeed, given those inflation numbers. But we'll see. We'll see what the inflation numbers do when they're published on the 18th. So it's definitely not a dead duck or a done deal quite yet. This is the root cause behind the issue here. So we've seen this this is where Russia invaded Ukraine here, and we saw then the huge spike in inflation, and then coming back down the other side, and we can see this little uptick here, both in CPI, which went from 1.7 to 2.3%, and CPIH, which is the consumer price index, but with home owner costs included in it. And it's those home owner costs that are giving us real pause for thought. That's this red line here. So these are the OOH, the owner occupier housing costs. And you can see that that index continues to climb and is now up at 7.4%, higher than it was a year ago. And that's what's driving it, that core inflation. That's a grave concern. This uptick in the CPI was mainly as a result of increased energy prices. Of course, the cap was lifted. Hopefully that will be a blip and we'll see that come down when the new numbers come out on December 18. So it's a fingers crossed. So where does that leave consumer confidence? And I'm going to try and demonstrate to you why I put so much store in this data here, by the way. Don't forget, there's zero. Anything below that line means the majority of people think that things are going to get worse. Anything above the line thinks that the majority of people think that things are going to get better. This is people's personal finances, which finally popped into positive this spring. And obviously with this big downturn as we came up to the budget with the Labour Party telling everybody that things were absolutely dreadful. Britain was broken in every aspect that you looked at. We saw it dip into negative, along with all the other measures. The red one, don't forget, is the overall index, but the green one, which is the climate from, is the next 12 months a good time or a bad time to make a major purchase? We saw that come flying down as well. And look at what people thought were going to happen to the economy over the next 12 months in that blue line there. An absolute it's a plummet. It's a plummet, and we always worry about plummets. So that's what happened. I said last month, I thought that was going to be a blip, and I said I thought that we would recover from that, and I didn't necessarily think it was going to have an immediate impact in terms of volume of sales and prices. And I think we'll be borne out with that. We certainly saw a bit of a recovery in the numbers that were published last week. The next numbers now come out just before, well, it's December 13th. So the next numbers come out in a couple of weeks, and it'll be really interesting once people have had a chance to properly digest what the budget means to them, how that affects consumer confidence. And if we look at that wonderful chart, and you'll notice I've cut quite a few slides out of this deck this morning because of a little 2024 review that we did. But these are deals, according to Property Mark, these are deals that their member agents did at asking price or better. And you can see how we plummeted, another plummet there in autumn in 2022. A very difficult year in 2023, particularly as we came to the end of 2023. That was so tough. Q4 2023 was very, very difficult indeed. And we climbed out of it a little bit. And even though we've seen a bit of attrition here, the trend, I think, is a gentle climb. And it's this first time I'm going to mention it, but not the last in this MarketCast, a return back to the trading pattern of the 5 years between 2014 and 2019, something I'm going to christen the Faithful Five. Let me just show you quickly, just before I leave this, I just want to show you something. Okay, here's that consumer confidence chart. I'm going to just draw a line along here that is the average of all these measures. There's that yellow line there. And what I'm actually going to do is apply it to this here. And if ever you want an idea of why I take so much store behind consumer confidence and its immediate effect on the way that property deals are done. Don't forget, this chart here shows deals that are done at or above asking price. So it's an immediate thing. So what I've done is I've literally synchronized in September. So that's the September number there. Synchronize that with September there. And that just gives you an idea of the correlation between the mood and pessimism, optimism, that consumer confidence, and you can see how that correlates. Savills did a survey with their prime movers. These at the top, 1,000 prime movers that have literally just published just this morning, I think, actually. And in that survey, over 2/3 of the people that they surveyed actually said that that would actually restrict or diminish their chances of purchasing over the next 12 months. And that's very interesting indeed. 10% said that they were going to need to find extra budget to make their property move next month. So it is having an effect. There is no question about that. Halifax asking price index for Halifax published just this week, just last week, sorry, 1.4% down, which is a little bit higher than you'd normally expect. You'd always expect a slight drop in the rate of increase in asking prices in the autumn and November, but that's higher than usual. Interestingly though, 23% increase in buyer demand over the previous year. It couldn't have got any worse, could it? This was this part, October, November, December 2023 really was a very low point in the market. So seeing that increase in there comes as no surprise to me whatsoever. Picking out the bones out of the Rightmove executive summary, 26% ahead. Sales agreed all over a quarter higher than this time last year, but the market this time last year was so dreadful. They are now also forecasting, Rightmove, that asking prices, that's not selling prices, will increase by 4% in 2025. Interesting. Zoopla coming out the year exactly as they thought they would, with 1%, and that's probably, it's going to be there or thereabouts. This is that great algorithm that's a mix of asking prices, mortgage approvals and sold, done deals. This, though, is a very important slide for me when I'm trying to think about how volumes are going to be next year. And this is the pipeline compared to how the pipeline looked going back to 2019. So we've come all through COVID during this, but you can see right now, this pipeline sits up here, the highest it's been since 2020. That's a great indicator for me, and I think that is another piece in the jigsaw that says that those volumes are going to return to the pre-COVID trading pattern. If you look at mortgage approvals, they continue to climb. The latest numbers I've got, I'm afraid, are the September ones, but the September ones here you can see hit almost 66,000, within an ace of 66,000, and we know 66,000 is the magic number because 66,000 mortgage approvals translates 3 months later into 100,000 completions. That's how it works. And that classic 100,000 each month gives us the 1.2 million, which is the characteristic of the Faithful Five, 2014 to 2019. And another reason why I believe we are headed back there. But this is the talking point. This is the talking point right now. The stamp duty concessions that are going to disappear. This is a Zoopla chart that I've stolen here, but it's a great demonstration of why it matters so much. Have a look at this then. This is how things are currently. And this is for your average first-time buyer. 80% of them right now are paying no stamp duty at all. 14% of them are paying partial stamp duty, and just 6% are paying full. At the end of March, when suddenly that allowance drops from $425 to $300 for first-time buyers, And the rates for second-time buyers, the exemption, the 0% exemption, halves from 250 to 125. Have a look at this from April 2025. Suddenly now you've got 40% of purchasers are now dragged into that stamp duty envelope, and that will affect buyer behavior. Now, the really important point to make is that we've got wants-based and needs-based buyers, and the wants-based buyers might be deterred. You can't deter a needs-based buyer. If I'm buying a new home because my wife's having a baby, or I've moved my job, or whatever my reason is, but I'm a needs-based buyer, I don't go away. That need doesn't disappear. Needs-based buyers wait, they don't disappear. But what happens with something like this is it affects buyer behavior as they try to avoid the tax. And stamp duty, of course, is one of the most hated taxes. Have a look at this nationwide chart here using HMRC numbers. Look, here's the faithful 5 here going on here. This is 2014 to 2019. What all of those spikes that you see in this UK housing market here, every single one of them is as a result of stamp duty changes. Now, whether that is the change of the first-time buyer stamp duty holiday back here, whether it's the introduction of the higher stamp duty for investors and buy-to-letters, this stamp duty holiday, the COVID one, the first one, stamp duty holiday, second one, the extension of the stamp duty holiday here. People will do anything to avoid paying this hated tax. I tell you what, if we had tractors, we'd all drive to London. So that is why that is going to affect, that change is going to affect behaviour dramatically in the Q1 of next year. So when it happens, don't say you weren't warned, because I am guaranteeing it's going to happen. You're going to get a flurry of activity. And here's the thing, if you're unable to meet that desire and that need in January, you'll miss them. Those buyers will be gone. If you just got to think that if you squeeze everything out into that first quarter, out it comes. Then of course, as soon as that first quarter is over, that stream then dries up to not much more than a dribble. So that's so important. I've literally just put 2 RICS charts in here, and I think they're both important. This one here shows volume, sales expectations. A significant majority of the UK's valuers, the RICS members, believe that volumes will increase next year, and I'm absolutely with them on that. And here's one here is value, prices, how are prices going to go? Bearing in mind, these are surveyors, these are the people that do the valuations, and you can see the mauve one here is over the next 3 months. The azure dotted line here, there is over the next year. Look at that. That's a really very, very high proportion of the valuers, the RICS members, believe that values are going to increase over the next 12 months. I thought it was worth including those 2 charts in there, but we need to get to what next year. I've left myself just a couple of minutes really to talk about what we think is going to happen with values next year. This is so important, isn't it? This is where we were with 2024. So the dark blocks here are actual. I use the nationwide house price index as a measuring stick. There is any number of measuring sticks. It's no good using the ONS numbers, the land registry numbers, because they're so old. The latest numbers you've got, quite honestly, are last September. And that sort of September feels like a different country, really, doesn't it? And then, of course, the land registry, they publish the numbers for September, and then next month they'll change them all, say, no, we got them all a bit wrong. So these are the nationwide numbers because they give us an up to the minute reflection. Not perfect by any stretch, but it's what I call it's that consistent inconsistencies. So if you take them as a guide, those consistencies stay the same, well then the guide is valid in terms of trend. And here we go, this is what happened with prices, and this is where, in my view, prices are headed for November, December. We'll see the November numbers tomorrow, probably. The nationwide numbers are due out tomorrow. It's always a worry for me that the nationwide numbers, because they come out the following day, don't they? Right after MarketCast, puts you on the spot. But this is where I believe we're going. So this is the percentage increase over last year. The red line up at the top here is the average price of a property in the UK according to the nationwide. And this is where I see this going as we head up to the year, finishing the year probably around 260k. Diplo does still work on there, by the way. We'll shove him in. Look, I just need to move him a bit. And he does work. We are, I think, coming down the end of the Diplo neck before we get into the rise coming out of this winter into the next spring market. Let's have a look. What's going to happen? Quite honestly, 2024 is a done deal. I think the die is cast pretty much now, particularly when you look at times to go from reservation to completion right now. I think 2024 is close to being a done deal. There are still things out there, I'm sure, that you can race through, but that's going to come down to manipulation on individual sites on a site-by-site basis rather than any great movements or shifts in the market. Much more important as to what's going to happen in 2025. Here's my forecast, and this is what I believe is going to happen. I think it is absolutely going to be a diplodocus-shaped market. It's going to be a Diplo market, and I think that we're going to see the spring numbers showing an increase over last spring, and I think that we will see, here's the 260 mark for average price that we left in December, and I think we will see a rise as we go into spring, but I think then we'll see a general fallback in average price as we come through spring. But we'll see then that pick up again in the autumn. This is the classic Faithful Five, 2014, 2019 pattern. I have no reason, unless something happens geopolitically, unless something happens way beyond our control that affects the way the economy works, well then that is absolutely how I see the market going next year. And he does fit, look, he does fit. I probably need to manipulate him a bit. I probably need to start using a different dinosaur to have a look at that. And what does that mean? So if we take a return to the Faithful Five, I'm seeing that next year, overall, over the 12 months, it will be a fairly, if it is the Faithful Five, the important thing during those 5 years, number one, virtually every single year was 1.2 million sales. Virtually every year, within a few tens of thousands of completions, of legal completions, and their HMRC numbers. You can't get much more accurate than that. And also in all of those 5 years, it was positive price growth. I think the lowest of them was 0.45 or something, up to 4.5, but it was essentially in between 0 and 5% positive price movement through all of those 5 years. I have no reason to believe that this year will be any different. The one thing I would say is that I think that there is a potential for the volumes to be higher. And this is that classic point I was making just now about the fact that the needs-based market doesn't disappear, it waits. And so where we've seen a couple of years, certainly 2023, not quite so much 2024, that was coming back to the normal market pattern, but over those 2 years, we've seen a real restriction in terms of volumes, a real big reduction in volumes, and I think that we're going to see that increase. I guess the challenge to the industry is that their capacity has been significantly reduced. If you think about all the 10 quoted developers who came out with statements last year saying that their 2025 numbers, or certainly the current financial year, were going to show big reductions in volume, and so there is a concern about being able to meet that uplift. So market share for new against second hand is obviously the crucial question, and I think in terms of spec build, so I'm not talking about Section 106 and affordable stuff now, I'm talking about spec build market share, probably about 1.1%. You know, it's going to be 130 to 145,000 probably volume across the year. It will be very, very interesting to see. And of course, the key question for every developer is what it would cost you to affect that natural level of market share in a local market. And it means that micro and local marketing becomes ever more important. You don't need me to tell you that, I know. If you look at volumes then, I just thought it was worth sticking this down in here so that I can impress upon you those years there, they are actual HMRC numbers, are 2015, 16, 17, 18, 19. They are the Faithful Five in between 2014 and COVID, and you can see, and then we had COVID, and then we had, if you squeeze that supply up and then you let it go, that's what happens. There's the rebound. And you can see that what we've had is we've had steady squeeze up and then down. And I think we come back to steady again, a little bit like the sea after a storm. And that's what I think that we are facing right now. I'm convinced of that. In summary then, October budget decisions will, the sticking the 2% on stamp duty for investors and buy-to-letters may well affect the smaller investor, the person, the single property or what have you, but I think that the bigger investors will just take that as part of the upfront capital cost. And I think over the longer term, I'm not sure that that will have a huge effect on the larger investor. You know, the PRS market, the private rented sector, I think for the bigger investors will stay there. The effect in Q1 is really something that you need to align your business to prepare for. There is going to be a rush of volume in Q1, and there is going to be a commensurate fall in volume, certainly in the first half of Q2. We need to prepare our businesses for that, and we need to shock absorb. We need to prepare prospective buyers for that and compensate them for what they envisage as a big tax penalty if they don't complete before the I think it's actually on the morning of the 31st of March, I think the rate goes up, but we'll give you more detail on that, obviously approaching the time. Inflation currently above the government target, making a rate cut unlikely in December, but possible depending on what the inflation numbers look like on December 18. And so we've got 2025 and 2026, I think we're back in the faithful five. It's going to be unspectacular. It's going to be steady, but the market is there for you to take advantage of that. I feel quite sure. And I think that we will see additional volume in 2025 because we're going to pick up some of the excess that we've missed, those needs-based buyers that haven't disappeared and that are just waiting. Okay, we're bang on the 30 minutes. I can't let this go without telling you about this. Today is the last day of our shirt auction. So all of these crazy shirts that I've been wearing for the last 2 years doing these market casts for you are all going up for auction. There are some of the little peaches here, there that are actually in this auction, and every penny raised is going to cancer research, which is the AF Oliver chosen charity this year. Not only that, if you actually secure one of these shirts and you post yourself on LinkedIn wearing it, I will add another £50 into the charity. So it's a brilliant thing. How do you do it? The easiest way is to either go to the AF Oliver LinkedIn page or go to my personal, the Matt Fleming LinkedIn page, and both of us have got posts there with a link to the auction site. It's the last day today. Even if you're not buying it for yourself, it doesn't matter. Buy it as a present for somebody. Imagine, hang it up in reception. Come on, this is a proper collector's item. Okay, that's enough of the plug for the shirt auction. I'm relying on you, by the way. This is a great cause. So there's no market cast for Christmas. We're going to let you relax and enjoy your Christmas without me barking at you for 30 minutes or so. Our next market cast is going to be in the new year. So all that remains is for me to wish you a fantastic Merry Christmas, a brilliant Sales 2025. A huge thank you to the MarketCast team. We've got Hannah here, got Joan, and we've got James here who have done, and Josie as well, who've done a fantastic job this year on MarketCast. And finally, from me, a big thank you to you, and I'll see you in 2025.